And hi subscribers, welcome to our first video. I am Nick and this is the 23rd of April 2016. We are doing our very first video for Charity Hedge Fund, and I've been volunteered because the others don't like the technology. Anyway, so we shall start as always from the sector that actually dictates all other sectors, and that is fixed income. Not just because I was a fixed income trader for many years, but because I truly believe that fixed income is the thing which determines all of other asset values. So here we go. Let's start off with the 2-year note and in the US, and let's have a look at the biggest picture, which is the weekly. As we can see, we have a wonderful sloping trend line upwards, meaning that prices have been trending up for many years. As you can see, this is slightly enhanced, but it goes back all the way to 2013. And we have a very nice upwardly sloping channel, which we are nowhere near challenging. Let's have a look where we started the year. We started the year right here at 108.5 basically, and we've done nothing but rally up here and then come back when the stock market improved, but since we couldn't crack the trend line, we went straight back up, and now we're coming back down. Well, what can we say about this? Not a lot at the moment. We can say that we have a lower high, but we don't have a lower low. I think this trend line is amazingly important. Any talk of reflation of the economy is not going to be complete until we have managed to crack that trend line. Let's go now back to the dailies, again on the 2-year note. And again we have a trend line, we have support, and we are nowhere near to cracking it. All we can say is that finally the 50-day moving average has started turning over. But we're very close to the 200-day, and we are having a compression of the Bollinger Bands. Does that indicate very much? No, not really. It just shows you there's huge support here at 109.30, which is only about 8 ticks away from where we are, and that level is going to be extremely important. Until we have cracked this trend line, we cannot say that fixed income has given up. All that's happened is that when the stock market collapsed early this year, people fled into short-term instruments, and then they got out, and then because it couldn't go any lower, they go back in, and now they're getting back out. So basically what we have is an up down, but trending nowhere. If we look on the 300-minute chart, exactly same picture. We have a slightly negatively sloping 200 moving average, but not much is really happening. This is a trading market, not a trending market. Same thing for the hourlies. Not a lot to be said. It's just trading at one level, correcting, trading at another level. Basically what it's saying is that we are going into the FOMC meeting next week, and we didn't want to be too high just in case they did something, but that the chances of them doing something are quite slim. But on the other hand, they could say we will do something in June and that is what you have. you have basically a market which sold off slightly just in case they're slightly more bearish than currently. And that's about it. No trend whatsoever at the moment. If we look at the 5-year note, and here we are, we see much the same picture. On the weeklies we have a wonderfully nice up channel, and we are somewhere near the middle of that channel. A lot of the times when the market is indecisive ahead of big events like FOMCs and stuff like that, it just comes back to the middle of the Bollinger Bands. And that is all we have done. We have come back to the middle of the Bollinger Bands. We are significantly higher than we were at the beginning of the year, even though the stock market is back at its highs. And what can we say? Not a lot. Again, a slowly trending upwards market with very little conviction. And if we want to believe in any reflation trade, we need to desperately crack this trend line and close below it. We are, as of April, nowhere near it. So no need to get overexcited about bearish price action like here. All we have done is gone back to the Bollinger Bands for support. But for the very first time at these levels, we have a negatively sloping 50-day moving average, while we have a upwardly sloping 200-day moving average. Wouldn't be surprised to test these levels next week, but hold them, and that is only 6 or 8 ticks lower than we closed on Friday. Same for the 300-minute chart. Flat as a pancake, up, down, but actually going very much nowhere. The hourly is slightly more bearish, but nothing special. I think we will have plenty of support around this level, 120.08, and we closed at 120.16. So very few ticks lower, we have a lot of support and an area where you might be thinking about going long. 10-year note. Again, from a long-term view, the same wonderful upwardly sloping channel. We are coming back towards the middle of the channel, but we have not made a lower low, even though we have made a lower high. We can't really say very much about this, apart from the trend is still intact, the trend is still up, but hopefully we might get better levels to buy. That is reflected in the dailies. We have a trend line here which is support. We are at support. We might crack that support slightly next week and come back to these levels, which is what, 128.11, which is hardly a point lower in 10-year notes, hardly anything. But until we have made a lower low, we can't really say that this trend is changing in any way. 300-minute chart, flat as a pancake, going up and down, not very much to be said about it at all. What can be said is don't get too bearish away below the 200 moving average, don't get too bullish when you are above the 200-day moving average. We early in the month made the mistake of getting too bullish here, and we paid the price. But thankfully we got out when it started breaking this 50-day moving average. It is downwardly sloping. The 200-day is beginning to slope slightly down, so there are some reasons for hope. So what we might want to do is sell somewhere around 130 and a quarter, which is this area, against 130.06 and see what happens. But that's basically all we can say about this chart. We have the start of a reflation trade, but price has definitely not confirmed it. If the reflation trade does take hold, and this is back into the weeklies, look how much room we have to go lower. We have huge amounts of room to get lower. So there is no reason to have huge positions at these levels. If we've identified the reflation trade and we've identified that we want to be short, we can start selling a few rallies in small amounts and see what the P&L, which results, tells us. If it's negative, it tells us not yet. If it's positive, it tells us look for levels to add. But there are no reasons to be in a hurry either way here. Not from a weekly or a daily or a 300-minute or even an hourly chart. No reason whatsoever. The 30-year bond, which is the one that you would have thought the bond vigilantes would go for first, should the reflation trade take hold, is telling us absolutely nothing. We do have a slightly lower low, but again, we don't have a lower high, but we don't have a lower low. So this level here, 131, 161 and a half, 161 and 3/30 seconds, call it 161, is going to be extremely important. If we can close a week below 161, we will have had the first signs that we could be in a bearish cycle for bonds and a steepening yield curve, which is very important, because a steepening yield curve tells you that the economy is doing better than it was. But there again, look at these trend lines. You can't really say that you've done anything, that you've confirmed anything, until you've cracked these trend lines. And look how far away we are from those trend lines. This trend line at the moment comes in somewhere around 151. We are at 162 and a half. So we are many points away from confirming anything, which doesn't mean we can't trade it to the bear side, but we mustn't get wedded to any position or any macro viewpoint until price confirms what we have been seeing. Look where we started the year. We started the year here at 154-ish. We are still 7 points above it. If the reflation trade is going to take hold, we have to significantly crack the levels at the beginning of the year. So we are a long way away from confirming anything. In the shorter time frames, much the same. Nothing at all that we can say. Do we have room to come and challenge these lows? Yes, we do. Are we going to crack them? Probably not. Certainly not before the FOMC later on this week and before we get some really important data. If we crack this level, 161, then we can start talking about a seriously steepening yield curve and something interesting happening on the macro side of things. At the moment, we can do minor shorts on rallies, but that's all we can do. That's all that price tells us that we can afford to do. Let us swiftly move on to the EU German yield curve with something that a lot of people don't look at, which is the 2-year note, which is called the Schatz. Well, as you can see, this is very much similar to the US 2-year note, i.e. a wonderful channel, upwardly sloping. We are nowhere near as yet to crack it, but the yield here is significantly negative. So it is our contention that if we get a reflation trade, we will see it first in the EU curve. Why? Because people will want to get out of something which has a negative yield first. That would be the most logical thing to do. We are still in this upward channel on the weeklies. This is a weekly chart, and we have not cracked even the center line of support. This is the bar from the previous ECB decision day, which was about a month and a half ago, and we have gone from overbought to the center line, and we are still tracking the center line. This tells us that not a lot has changed here. If we go back to the dailies, again we are way above the support line. Nothing yet here tells us that we are in a reflation trade. We have a slightly negatively sloping 50-day moving average. We have a positively sloping 200-day average. We are somewhere near the middle of the Bollinger Bands, so we are seeing absolutely nothing as yet to tell us that we are in a reflation trade. What will be the trigger? Well, our first contention is this low here, which in a few days time will start coinciding with the trend line. So 111.7, that is the magic level where we could start seeing some proof that price is agreeing with the reflation trade. So mark that down, 111.7. We're not a million miles away from it, but there again we are nowhere near confirming the bearish price action that we expect. If we look at the 300-minute, we have again a negatively sloping 200-day moving average, while we still have a slightly positively sloping 50-period moving average. Sorry, this is a 200-period moving average, not 200-day moving average. So what is it telling us? Well, it's telling us sell against here with a stop above, and that's about it. That's all it's telling us. Same thing for the hourlies. Not a lot going on here. We have a bit of a trend line, but we closed the week right up at it. People are still buying the short end of the curve, even though it is deep, deep, deep into negative yields. Let's have a look at the bobble, which is the 5-year note on the weeklies to get a big picture. Well, still upwardly sloping trend line. We are now here at around minus 25 basis points in yield. So if we are going to get the first signs of a reflation trade, we really need to see it in the 2-year note and in the 5-year note. Why have a negative yield if you can afford, if you can move out to equities or to other asset classes which have positive yields? So still very much sloping, upwardly sloping trend line, upwardly sloping moving averages. We're not even at the middle of the Bollinger Bands. There is absolutely nothing telling us that this is a bearish chart. It might turn bearish below 130.35. So that is the level that we are looking at, and the chart looks very much the same in the 5-year note as it does in the 2-year note. In a few days time we might get there, a few weeks time we might be able to crack this line, which will be the first indication that we are in a reflation trade. On the dailies, this is the same thing. This is the trend line, that's the level, 130.35. If we crack that, we will be in a different position from a macro point of view, and that is where we shall get bearish below there. Above there we can have some small positions until price confirms. We shall do nothing more than that. 300-minute moving average, much the same, nothing much going on. Moving averages are compressing, Bollinger Bands are compressing. It's telling us it will make a move. We just don't know yet at this point. Is it going to be higher? Is it going to be lower? We must be controlling risk at this point, not adding exposure. Owlies, same thing. It's beginning to roll over, but we have plenty of room. This is 131 and 30, so we have plenty of room to those levels to sell. No rush, that's all there is to it. It's not telling us that there is any rush to do anything. Bunds, again, much the same picture. Upwardly sloping trend line on the weeklies. We're nowhere near even the middle of the Bollinger Bands, which comes in around 160.5. Until we have taken out that level, 160.5, we can't even think of talking about a reflation trade. And after that we still have support way down around 157 and 3/4, and until we have cracked those we can't really say very much at all about this contract. Here underneath we have volume, because every time we've had a large move down in bunds, the volume has been nearly twice what it is normally. Look at these bars, it gathers steam. So this is what we want to see. If it continues to move down next week, we want to see an increase in volume. This week we have an increase in volume over last week, and we have an increase in volume over the previous weeks. This is what we like to see, increases in volume. That's telling us something could be starting, but play it small, play it tight, don't get overexcited. Same thing for the dailies. Look at this wonderful channel. We're nowhere near the bottom of the channel. We would like to be very much closer to the bottom of the channel. Over the next few days we could get there. We could get to this level, which is around 157, 159 to 158. If we get there, we will be bearish. This moving average will be coming above it. We will be bearish below it. So we'll be adding to positions as it cascades. We want to see large volume on a break of these levels. Large volume. We're not seeing that yet. That is why we have minimal positions, and we will not increase until we see cracks in these levels. This contract has come from from par, from 100, and it's now trading 160. Even if we sell 157, it is still early in the trend, very early in the trend. There is no rush. 300-minute not telling us very much. Try to sell against 163.30, 50, this area here, and see what happens. It's telling us don't get overexcited here. Get excited if we break these lows around 161, 160.85, and then finally get excited if we break this trend line around 157. But for now, not very much at all happening. On the hourlies, yes, we do have a bit of a rollover in the 200 period moving average, but that's an hourly that could easily come back to 163, 30, 40, 50. We were here when we started shorting it. We slightly added a little bit here, but we will be patient. We will wait for rallies back up to here. There are no reasons why it shouldn't happen. So we shall try our first little short around 163.10, 20, and then again around 163.50, and we'll play it by ear. We'll see how it feels. If it starts breaking these levels again, 164.15, 164.20, then we're definitely wrong and we'll be getting out. So that is the fixed income market. Moving swiftly on to equities. Well, again, let's have a look. Since this is the first time, let's have a look at the big picture. The big picture tells us that, again, we are in an uptrend. Well, nothing new about that. What it also tells us is that it seems to be working very nicely and not closing below the Bollinger Bands. The Bollinger Bands come in at 161.25 and 118.35. So we are very much closer to the top of the trading range rather than to the bottom. Does it tell us that we have upward momentum? Yes. Is the momentum waning? Yes. Is there room to come back to the center line? Absolutely, and that is around 1975. So can we have setbacks here? Yes, but don't get overexcited. On the dailies, the picture is pretty clear. On the Bollinger Bands, we have very good. On the Fibonacci retracements, we have very good support around the 2030 area, which we couldn't crack earlier. And then finally around the moving averages, the 200-day, the 100-day moving average, all coming in at around the 1960, 1970, 1980 area. So this area here is going to be key. Any breakdown here below 60 will probably result in a test of 30 to 60 area plays, and then we might move back down to below 2000. 1980 is going to be key, 1975 is going to be key, but we don't think this is going to happen very quickly. We see no reason for any panic. If we look at the 300-day, 300 minute, we can see that it is basically losing upward momentum. But that is all we're seeing at the moment. Could it break down to 2030? Yes, it could, but it could easily, for the next few days, play in a range between the low 70s and the low 2100s. That is all that it's telling us. It's not telling us there is any big change in trend which is imminent. The hourlies are telling us much the same thing, so I won't even show you those. The Russell, the Nasdaq is actually a far more bearish chart, but there again on the dailies it has excellent support around the 200-day moving average, which is right here at 4,415, 4,400. So we shall definitely be trying to attempt to buy the 4,400 area for a small bounce, but if it doesn't work, we'll be very, very quick to get out. I think the Nasdaq could be leading the S&P, and that is why we don't really want to be too long, because if the S&P, if the Nasdaq starts breaking down, believe me, the S&P will eventually follow. The VIX, which is certainly something that we look at a lot, is basically telling us that it's coming to areas where it's certainly far better to be long than to be short, and that is around the 11 to 12 area. We're now 13 and a quarter, so we're hoping to see slight drives down next week and the week after to be able to buy it. And this is a weekly chart of the VIX. So this is the area that we'll be looking to get long in. On the dailies, it's not really telling us very much. It's telling us maybe there's a loss of downward momentum, but it's not giving us any triggers or any reasons to suspect that we are going into an explosion of volatility. I mean, absolutely nothing there, unfortunately. We wish there was a trigger, we wish we could see it, but we can't. The European equities side, it's more bullish than the S&P. On the weeklies, we bounced off the 200 week moving average, and we've bounced straight back up to about a 50% retracement of the whole move down around this level. This is going to be huge resistance between 10,500 and 10,900. Huge resistance here. We don't think this market can really do much beyond that. There will be very, very, very difficult to break these levels. So we are hoping for moves back to this kind of area to buy it for the next test of these levels up here. Let's have a look at the dailies, and this is what we are hoping to see. We're hoping, since the 200-day moving average is still downwardly sloping, we're hoping that any test of this gap, which is the initial gap for the year, is going to reject and is going to come back to around the 9,800 area, where we think we can profitably establish a long. Now the stocks is the most interesting one, as you know. It is on a weekly, it looks very similar to the DAX. It bounced off aggressively off the 200 week moving average, and it has huge resistance here, another 100 points higher. These levels are going to be very tough to break, 3,100, and again, if you look all the way here, 3,163. So this is the maximum that we can see this contract doing for the time being. We want to see a very nice retrace back into this level, 2,850-ish, to buy it again for a break back to this trend line, because we think that if we're going to see a reflation trade, this is going to be the contract, because it contains many more companies which are Italian, French, Spanish, where the biggest room for appreciation lies, as opposed to Germany. So we would not be surprised to see this contract trade here at 3,150 to 3,200, come back below 3,000 to around 2,900, 2,950, and then make a large move back to 3,500 in the second half of the year. That, we think, is going to be the trade of the year, buying it when it has retraced from this move around this level here. On the 300-minute, much the same story. We want to see maybe a spike here, but then a move back to 2,900 for another launch pad higher to 3,500. And that will coincide very well with turning this moving average from negative to positive, and then we can be in a multi-year trend higher. The Nikkei is also interesting because of it is actually a yen trade, a foreign exchange trade, rather than anything else. We're thinking at the moment it is coming into huge resistance on the dailies and on the weeklies. Let's have a look at the weeklies. Again, very much like the DAX and the stocks, it bounced off the 200 week moving average, and now it's going to probably test this kind of area around 18,500 before he moves back down and then launches again, which would imply a much higher dollar yen, somewhere around 130 in our opinion longer term. Daily picture is very much the same. Short-term resistance, come back, go. Nothing really to be seen in the 300 period moving average. This is a level which has been respected many times, 18,095, and where we think we will have big resistance. This goes all the way back to for many weeks. Now let us go to currencies. The euro on a weekly chart basically tells us not a lot, and that is surprising because we will be wanting to see a stronger euro if there is going to be a reflation trade. At the moment, all we are seeing is a steeper US yield curve, with the European yield curve being dragged by the US. We would like to see the European yield curve to start leading the US curve. If there's going to be a reflation trade, it has to be a worldwide reflation trade. It can't be just a US reflation trade. Therefore, we would like to see the euro lead us higher. And what is going to lead us higher? Well, the fact that EU rates are going up faster than US rates. We all know that the economy in the US is doing reasonably well. The question is it doing 1% reasonably well, or is it doing 3% GDP growth reasonably well? Fine. That isn't what's really interesting from a macro point of view. From a macro point of view, what is interesting is when is that growth in the US going to spill over in other areas of the world. The US can't get us out of this situation that we're in all by itself. It can be a locomotive which pulls along, but if we are going to have a worldwide reflation trade, we need other sectors like Asia and Europe to start taking the strain away from the US. So we would want to see a much stronger euro before we are convinced of a reflation trade. And if you think about it, if bunds are falling, i.e. the yield is going up, and the yield differential between the US and the EU is coming in, then that will prompt a reversal of this trade. This is actually the trade where the EU yields were falling faster than US yields. So we would want to see a reversal of that. We are not seeing it as yet. That is why we don't want to be enamored with any position which says we have reflation. Go short bonds, long equities. We're just not seeing it. There aren't any triggers. All these markets have to confirm that trade. Are they doing so? No. All they're doing is trading between lower Bollinger Bands and top Bollinger Bands. All we're doing is coming back towards the middle. We've had a 110.50 pivot all year long. I mean, even for 2 years in the euro. It just trades either side, 2-3 percentage points either side of 110.50, and that's all it does. It finally has to make a sustained move before we can say yes, this is now reflecting a reflation trade, or at the moment we can say no, it's not reflecting a reflation trade. There is nothing going on here which confirms our view of the world. It's still a trading market. Sell 114, 115, try to buy back 110.50, end of story. On the dailies, much the same. This line here around 115, we just can't close above it, and we try, we fail, we try, we fail, and finally we go back to the 200-day moving average, which is at 110.50. That's all that's happening here. We are in a 3-4 big figure range. We play the range, and that's the end of it. We want to see this line taken out. That's all that's going on. Now, the yen, of course, is much more interesting. We tweeted that we didn't think it was sustainable below 105 or 107. We have this moving average here, and in the weeklies, let's expand the weeklies, we were hoping to be able to buy this area. Well, it didn't happen. It's come right back into the moving averages. It might go a little bit further towards 114, 115, but then it should trade back. And this is going to take many, many months of trading before this contract makes another large move. We think the next move is going to be in that direction, above 125, and that is going to confirm to us that we have a reason to buy Nikkei. At the moment we don't really. We're just trade, we can trade it for 200 points, 300 points, but that's about it. On the dailies, again, we broke back in, which says that we rebuy this trend line to play ping pong in this area. That is what we think is going to happen. We're going to be playing ping pong in this area for the next, I don't know, 2-3 weeks at least, until we have a much better handle about what the Fed is going to do in terms of interest rates and what the Japanese are going to do. Could the Japanese surprise and do something silly? Of course they can, but we would much rather see a break of that line to get bullish again. And the one which is interesting is the pound. Well, funnily enough, we think that the pound is building a wonderful base here. A multi-week head and shoulders, inverted head and shoulders, which will break at some stage, break this trend line and go to the moving averages, which will be somewhere around here, which will be somewhere around the 155 area. Is it going to happen next week? No, but we will definitely be looking for areas to buy the pound, looking for a move back up to the mid 150s. This basically says no Brexit. That's what this chart says. This trend line here and that trend line here say there's a danger of Brexit. Busting these trend lines, and don't forget that the market is always looking forward and not waiting for a Brexit referendum to move. It will move significantly well before the Brexit referendum. So we wouldn't be surprised to see cable trade well into the 150s before the Brexit referendum. the dailies are basically confirming the same story. We have a flag developing here. We're beginning to break out of the flag. We would have thought that sometime in the next 2 weeks we shall go and test 147, 148, and then finally break back up and be over 150 by the time the referendum comes. Dollar index, this is the one that we tried to put on the trade, but we failed. If you remember a few weeks back, we tried to put a trade at this level. We wanted to sell 96.50ish. It never quite got there. It missed by only a few ticks, and then it came back down to test support. If we look at this from a weekly point of view, we are seeing nothing too bearish here. This is the 0.382 retracement all the way 92.18. We are nowhere near it. We have the moving averages pretty stationary around this level. We think in the next couple of weeks we could see the contract spike these moving averages all the way to 96.83. We would give us a euro somewhere around the 110 area. We will definitely try and play it. We just don't see any impulsion lower here. Basically what this contract is telling us is that the Bund for the time being will not break down. The 10-year note might go down a few ticks, but the Bund is going to outperform the 10-year, i.e. it's going to go down less than the 10-year note. So it's telling us if you want to be bearish some bond, be bearish the 10-year note, don't be bearish the Bund. That's what it's telling us. That's why the positions we have in the bonds are so insignificant and irrelevant, because we just can't quite see it. We would want this contract to confirm. This contract is 60% made up of euro, so it reflects basically what the euro is doing. It doesn't reflect much of anything else. It's not telling us to get short of the German yield curve. It's just not. All these various pieces of the puzzle have to fit together before we put on a very significant position. On the dailies, 200-day moving average doing nothing. Where is it? 96.90. Can we bounce up to the top of this channel, 96.50? Yes, we can. Does that mean anything again in the larger scheme of things? No, it doesn't. It just means that the market is still not confirming a reflation trade, and it's not in a deflation trade. It's saying the market needs a lot more time to decide which way it's going to go before it does it. Now let's have a look at Canada, because that is also quite interesting. Canada should reflect what the oil price does or will do. It anticipated on the way up the fall in the in oil, and it anticipated the turn in oil. So while it's still bearish, it tells us that the oil trade is still ongoing. When we see oil making new highs while Canada is not making new lows, that's going to tell us that oil will turn very, very soon. That's why we keenly watch Canada. At the moment, it's not telling us very much. It's telling us, yes, you know, if you want to play Canada, you play it by being short euro against Canada or being short Swissy against Canada, but do not have a large position in Canada dollar. There's no reason it trades very well within the Bollinger Band, so it's very close to, to bottoms. It could have a vicious spike, so do not have very large positions. I'm afraid that these markets are all telling you to avoid having large positions. We can't help it. You cannot force a trade. You want to bat when you have all these Lego pieces, puzzles coming together. At the moment, they're all saying different things or saying different things with different intensities. Gold, again, what's it telling us? I mean, apart from the fact that it's broken these trend lines and that it's now consolidating, it's not telling us very much more. It's telling us that it cannot sustain the 112.75 level. It just cannot sustain it. Every time it gets there, it gets smacked back. What does that tell us? That probably the reflation trade has come as far as it can for the time being. It needs time to digest, maybe retrace back to 11 below 1200, between 1200 1150, play around for a few weeks and then have another go. So it's telling us that the timing, even if we're right about the reflation trade, the timing is not now. It needs more time to digest information, play around in this area before he makes another move. If it starts making another move, then we can easily say that the reflation trade is being led by something. It's being led by gold, it's being led by silver, and we should put it on. At the moment, basically all it's doing is retracing this move from there to the highs. It will probably come in to the 0.382 retracement, which is just below 1200. Maybe it's worth a small long there, maybe it's worth another small long around 1168, which is the 50% retracement with this 200-day moving average turning around. At what it's telling you at the moment, do not have huge positions on. You could be bearish a bit of gold, no reason why not. It might trade $30 lower, $50 lower, but it's not going to trade $100 lower, and it's not sustaining moves higher, which is our preferred direction. The reflation trade is not being confirmed by too many things at the moment. Silver, this is a very, very difficult contract to trade. It has large moves for no reasons. Let's have a look at a daily chart. I mean, here we are at the beginning of 2015, where it smacked back up to 18 from 15, from 14. Why did it do that? Did anything happen? Nope. Why did it go back up to around these levels that we saw on Thursday in April of last year? Nobody knows. This is just basically a contract which has a will of its own. We don't trust it. We know that it should confirm a reflation trade at some stage, but again, we much rather think that it's going to come back towards the 200-day moving average, which is just north of 15, rather than keep on going. If it keeps on going, we'll have to respect it, but at the moment we just don't see it. So that's all there is to be said about that. Oil. Now, oil is interesting up to a point. It's telling us that it's vastly oversold. I mean, this is a monthly chart. Let's take it into a weekly chart. It is coming to the top of the Bollinger Bands, and it's coming to the 50-day moving average, 50-week moving average, which is significantly higher, around 50. Okay, so what it's telling us? It's telling us that could we get to 47, 48, 49? Yes. But I think it's telling us that we're not going to go and spike these levels around the 58 area. It's telling us we have a very, very modest reflation If we bust through this level, through this 47 level, or maybe even this 45 level, we can see some acceleration. But at the moment, it's very, very slow. And it's telling us that the reflation trade is a slow trade. That's going to take a lot more time to take effect than people might think. Therefore, it's telling us, do not be in a hurry, I will retrace. But it's a technical market. It's not a trending market. It's a technical market in all contracts. There is not a single contract out there which is telling you go and put on a large position in anything. They're all telling you trade the ranges, trade the technicals. Finally, let's look at something which we like looking at, and that is the earnings and valuations which Yardeni publishes every week. This is the latest publication for April 22nd, and it basically shows you the S&P Blue Angels. It shows you where the valuations are. These are the multiples of the forwards that the market is expecting. As you can see, at the beginning of the year we smacked from a nearly 17-time valuation all the way down to a 15 times valuation, and now we've gone back up to a 17-time valuation. Since 2007 it has never traded above a 17 times valuation. So it's telling us, do not be overly long stocks at these valuations. There is no reason to do so. These are the various sectors. If you want to be long of a sector, consumer discretionary is not a bad sector to be long of. Consumer staples is not a good sector to be long of. It is vastly overbought. We own, in our various funds, we own absolutely no consumer staple stocks. Energy. What's this chart telling us about energy? It's telling us nobody believes oil will trade at these levels forever. If they did, these stocks would be much, much lower. These stocks, instead of trading at 500 on the index, would be trading at 150. So people are saying the long-term price of oil is significantly higher than it is at the moment. It's in the 50s, it's in the 60s. That is what people are saying. Okay, it could well be so, but it's a very dangerous game to be long, overly long of oil stocks, when even if the contract gets to 50 or 60, these are going to see minimal, but minimal appreciation. They might see 10%, but that's about it. So we don't have too many. Financials. Don't be overly long financials. Healthcare. You can be long of healthcare. Finally a sector that you can be long of with pretty much not a lot of risk. We definitely like healthcare stocks. If anything, we would be long of healthcare short of S&Ps. Industrials coming to the top of the range. That is why we don't think the S&P will be very strong over the next few weeks. There is no reason to expect that the industrials will see a considerable leg higher. No reason whatsoever. Information technology. Well, you know, it could come back to 700, but it's not going to go much below that. So again, Nasdaq, is it going to break down hard? Could it come back down 5-7%? Sure. Do you want to buy it if it does? Yes. And finally, materials. No reason to be overly long of materials at these levels, which basically tells us that any big rally that takes place from these levels in something like the Australian dollar, you want to start getting short of. this is the one trade that we think probably is going to be the best trade over the next few weeks. If the Australian dollar spikes its Bollinger Bands and trades some level around 80 to 81, you want to start getting seriously short of the Australian dollar. You want to own puts on the Australian dollar if it trades at these levels, 80 to 81. We think it's going to do the same thing as Canada did here. It'll be that kind of a spike, and then it'll come most of the way back. So that is really what we have to say for you today. I hope you've enjoyed it. It's been a little bit longer than normal, what it will be, because we thought we'd cover as many contracts and as much as possible for the first week. Please do write to us, tell us what it is that we are doing wrong, that you would like us to cover that we haven't covered, whether you like more details about anything. We look forward to hearing from you and doing something better next week. Thank you very much.